Hello and welcome to this latest video update for the Henderson Diversified Income Trust. Today I'm joined by the fund manager Jenna Barnard. Jenna, thank you very much for joining me today. Now, first of all, what can you share with us about your activity on the HDIV portfolio since the end of the year?
Frankly, there's not been a huge amount of change in the portfolio. It's expensive to trade corporate bonds, and we have a relatively strict style, so any bond that makes it into the portfolio should adhere to our style of sensible income. So no cyclical exposure, no companies with huge operational leverage. We just want dull, boring, reliable businesses, albeit with a reasonable amount of debt, so we get a decent coupon. So we're not the kind of fund managers who are looking to trade small cyclical changes in the market, or trade a rebounding growth for a month or a quarter. It's not how we think. We think about fixed income thematically. So what is the climate of fixed income investing? And for us, that's a low inflation, low growth backdrop throughout the developed world. What's interesting this year is central banks have started to come round to that view of the world, having panicked about a potential pickup in inflation last year. Central banks like the Federal Reserve in the US are now saying there's not enough inflation. We've undershot inflation for 10 years. So in a way, the world and the market and central bankers are coming round to the way we've been thinking for a number of years. And the portfolio is positioned to reflect that. We're not shy of longer dated quality investment grade bonds, which have a lot of duration or interest rate risk inherent in those bonds. And within the high yield market, we're very focused on the upper end of that market, kind of quality, BB rated, as I said, sensible companies. So I think actually for us, we haven't done a huge amount in the portfolio. That reflects the way that we think and manage the assets. And what's really changed is the narrative. The narrative in markets is much more sympathetic to the way that we think, whereas last year was more of a struggle, certainly for the first 9 months of the year.
Okay, and what's the significance of the change in mindset by central banks, as you mentioned? What does it mean for your view of the world?
Yeah, well, I mean, the pause from the Fed in terms of interest rate hikes, and I think probably the end of interest rate hikes in the US for this cycle, is very important because they were pretty much the only central bank in the developed world, with the exception of Canada, who had an actual interest rate hiking cycle. We did not have a rising rate environment in most other countries. You had the occasional flip-flopping from the likes of the Bank of England, who cut and then hiked, but very modest, really nothing in the grand scheme of things. And a number of countries have only cut interest rates since 2015, the ECB, Japan, Australia. So it's this very divergent world of interest rate policy, a very unusual interest rate cycle globally. And as I said, with the Fed being the only normal central bank, in a sense, the fact that they've had to halt interest rate rises with a 2.5% interest rate, which is very low in the grand scheme of things, sends a very important message. We are stuck in this low interest rate, low inflation, low growth environment. And I know a lot of people have been sceptical about that and anchor back to the 1990s or the early 2000s. We've never been of that view. And the core message is it's very hard to get out of a low interest rate environment. And it's very hard for any one domestic central bank to generate inflation. There's a global theme going on here, which frankly, central banks aren't really in control of individually. So what does that mean? It means bond yields are lower, as you would expect. Bond yields have really collapsed since November, December, even in the US, but in many other markets. And the bond market is starting to get the sense that interest rates may never go back to a normal level, or whatever you think that normal level might be. So it's quite profound. It's very important, and we now have a sense of the peak in interest rates being behind us. As an bond investor, we're thinking, how low do interest rates go in the next downturn? And not only that, but once they get to the zero bound, or in some cases negative interest rates, what else do they do? Do they do quantitative easing? do they use fiscal policy? Does monetary and fiscal policy start working together? There's going to be a whole new regime, and I think that's where the mentality of bond investors is increasingly focused.
And lastly, what can we reasonably expect to see from the HDIV portfolio over the remainder of the year? What's the strategy?
If we're right, nothing, frankly. As I said, it's expensive to trade corporate bonds. We don't want to trade corporate bonds. There's a natural need to reinvest when you have maturities or bonds being bought back by issuers, and we have to then reinvest the proceeds, or an interesting new issuer comes to market that we haven't seen before and like. But generally, if we're right about the world and we've done the right credit selection and adhered to that sensible income style, then ideally we don't want to do anything on the portfolio. There may be market opportunities, but I think the chances of bond yields, government bond yields moving materially higher this year is actually quite low. So it's unlikely to be an opportunity for us. In my view, there's a bigger risk that bond yields actually collapse even from here.